Okay, so you want to own a water damage restoration company. Get a van, stack it with fans and dehumidifiers. Answer the phone at 2 in the morning when a basement floods. Pump out the water, dry the place, send the insurance company the bill, and watch the money roll in. Every house in town has pipes. Every pipe can burst. And somebody is always going to have to show up. It sounds like a license to get paid for other people's bad luck. That's the picture. Sounds simple. It is not simple. And the story of how these companies actually make money and how they actually die is one of the strangest stories in all of small business. Because the work you can see, the pumping, the fans, the plastic sheeting, is almost the cheapest part of the entire operation. The real product is invisible, and the person who decides what that work is worth was never hired by you, never paid by you, and answers to a company that has never once walked through your front door. Keep that operator in mind, because we're going to follow one through the whole story. One truck, one owner, a whiteboard in a rented office, a phone that rings at odd hours, and a stack of invoices sitting on a desk for weeks waiting for checks. The exact numbers vary from shop to shop, but the shape of his story is the shape of the industry. Before we get to any of that, you need to know what it actually costs to get in the game. A real one-truck operation, not the fantasy version, needs somewhere between $50,000 and $175,000 before the first job. The equipment is where most people start the mental math. 12 to 20 air movers at a couple $100 each, a couple of refrigerant dehumidifiers around $1,000 each, the big low-grain refrigerant units at $2,000 to $3,000, HEPA air scrubbers around $1,000, a water extractor from $4,000 up to $25,000 if you want the truck mount, moisture meters, thermal imaging cameras. That full package runs $20,000 to $50,000, and it's the one-time part. Then the service vehicle $15,000 to $50,000. Then licensing, insurance, bonds, certifications, the part nobody films for the brochure, another $8,000 to $15,000. And then the part that catches almost every new owner off guard, the working capital. The money that keeps the lights on and the crew paid while the first checks are still weeks away. That's the part that quietly decides whether you last the year. Our operators skipped the fancy truck. He bought used, ran the numbers over and over, and still ended up financing more than he wanted. He told himself the working capital cushion could wait until the work showed up. That's the first lie the business tells you, and almost everyone believes it. Okay, so you've got the van, the fans, the certifications on the wall. Now the good news, and the good news is genuinely good. The margin on water mitigation is some of the fattest in all of contracting. Let's do the math. Say a standard residential job comes in at around $5,000. Labor, maybe $800. The equipment cost on machines you already own, maybe $300. Materials, $150. Disposal, another $100. That leaves around $3,650 of gross profit on one job. A gross margin in the neighborhood of 70 to 75%. Read that again. For every dollar the insurance pays you for drying, you keep roughly 70 cents before overhead. A busy month of those jobs and the fantasy looks real. And that is exactly where a lot of people make the mistake that ends them. Because they look at that margin and conclude that the business is the drying. It is not. The drying is the price of admission. The business is something else entirely. Here's the first thing nobody tells you when they picture owning a restoration company. The person who calls you is not the person who pays you. A homeowner's basement floods. They call you in a panic, you dry the place, you do everything right. But the check does not come from the homeowner. It comes from an insurance company that was never in the room. And the person who actually decides how much your work is worth is an adjuster. Someone hired by the insurance company paid to be skeptical of exactly the kind of invoice you're about to submit, and someone who has never once shaken your hand. Hold that thought, because we're coming back to the adjuster. He's the most important person in this entire business, and he is the one person you will never hire. So, where does the work even come from? You might assume the phone just rings when it rains. It doesn't work that way. The phone calls are fought over. The homeowner with a flooded basement is calling around, and so are 3 other companies. Whoever gets there first usually gets the job, not because they're better, because they're first. That's why this industry runs on 24-hour dispatch. That's why the phones are answered at 3 in the morning by a human being, not a voicemail. That's why companies spend real money on call centers and response promises and marketing most people never see. The lead, the moment the homeowner picks up the phone, is the real asset, and it's not free. Some of those calls are purchased. Some are sold to more than one company at once, and you're racing strangers for a customer whose ceiling is leaking while you argue about who got there first. Our operator won that race the only way a small shop can. He was willing to lose sleep nobody else would lose. He answered at 2 in the morning. He answered at 4. He drove across town in the rain. He took the jobs the big shops didn't want to leave the house for. And that's how he built a name, one soaked living room at a time. What he didn't understand yet was that winning the race was only the beginning of the race. The call was the easy part. Everything after the call was where the game actually got played. Because even after you win, even after you dry the house, the money does not arrive when the job is done. Insurance companies say they pay in 30 to 60 days. In the real world, the money shows up more like 55 to 75 days after the work is done, and that's when everything goes smoothly. That's the good timeline. Now think about what that means for a business where the bills arrive every single day, payroll every 2 weeks, fuel every week, the truck payment every month, the equipment loan doesn't care how many claims are pending. A company doing $200,000 a month in revenue is carrying roughly $400,000 in unpaid invoices at any given moment. That money is on someone else's books while your crew needs to be paid today. Some companies survive the gap by selling their unpaid invoices to a factor at a discount, trading away a slice of margin for cash in the bank. It keeps the lights on. It also quietly turns a 70% gross margin business into something that feels a lot thinner by the time the check clears. So here's the trap almost nobody sees coming until they're inside it. A restoration company can be completely booked, every tech busy, every truck rolling, new jobs every day, and still be losing money, or worse, running out of cash. Busy is not the same thing as paid. The schedule is not the same thing as the bank account. And the companies that look the most successful from the outside, the full whiteboards, the new trucks, are sometimes the closest to the edge, because every new job they book is another invoice they're fronting, another payroll they're covering, another 2 months of their own money sitting inside someone else's claims department. Our operator learned this the hard way. By his second year, he had 2 trucks and a wall of invoices. He'd stopped checking the bank account every morning because it made him sick. He was doing more work than he'd ever done, and he had less money in the bank than the day he started. That's the moment most owners do the same thing, and it's the move that reveals what the business is really made of. A water damage job comes in 2 halves. The first half is the mitigation, the urgent part. Get the water out, get the air moving, stop the damage from getting worse. That's the part the homeowner sees, the fans, the plastic, the equipment stacked in the hallway. It's fast, it's high margin, and the ticket is small, usually somewhere between $3,000 and $8,000. But the second half is where the real revenue lives, the reconstruction. The drywall that has to be cut out and replaced, the flooring ripped up and relayed, the cabinets, the paint, the trim, the whole rebuild of the rooms the water touched. That's a much bigger ticket, sometimes 5 to 10 times the size of the mitigation bill. And here's the catch that defines the whole business. The urgent part is the doorway. The homeowner who just watched their basement flood is not thinking about who's going to rebuild it in 3 months. They're thinking about who's going to stop the water tonight. The company that shows up first, that dries the house, that makes the nightmare manageable, that's the company they trust with the rebuild. So the fast, competitive, lower margin work is the hook. The big, slower, more profitable work is the payoff. And the shop that treats every job like it's just a drying job is leaving the biggest check on the table, over and over, for the company that calls the homeowner in 90 days. Our operator knew this. He'd read it in every trade magazine. He just never had the crew or the cash to stay in the rebuild game, so he dried the houses and watched the reconstruction checks go to someone else. So far, the whole thing sounds like a lock. The work is everywhere, the margins are fat. The payer is a machine with deep pockets, and the homeowner is emotionally desperate to say yes to whatever makes the water stop. Now here's the other side of the ledger, because the moment the payer is an insurance company, the system starts to bend. There's a war fought over every single job, and it's not fought in the house. It's fought on paper, between the contractor who wants the damage to look bigger and the adjuster who wants it to look smaller. In the worst cases, that pressure has produced outright fraud, contractors writing up damage that was never there. And it has also produced the exact opposite reaction, insurance companies treating every restoration invoice with suspicion, delaying, contesting, demanding more documentation, because the system has trained them that invoices are enemies. Neither side trusts the other, and the homeowner and the honest contractor both live inside that distrust. This is the part of the story that makes this business different from almost any other contracting trade, and it's best explained through something that actually happened. In the years before 2019, Florida had a legal tool called assignment of benefits. A homeowner whose property was damaged could sign over their right to the insurance claim to the contractor who came to fix it. That sounds like paperwork. It was actually a weapon. The contractor now had a legal claim directly against the insurance company, and the insurance company had no real say over who the homeowner picked or what the contractor charged. The alternative arrangement, a simple direction to pay, just asked the insurer to send the check to the contractor, and in most states the insurer wasn't legally bound to honor it. The assignment changed the balance completely. What followed was a documented explosion of litigation. Contractors and lawyers found that the assignment made it profitable to pursue claims aggressively, sometimes far beyond what the damage warranted, because the insurance company was paying the legal bills either way. Premiums climbed, carriers started pulling out of the state, and in 2019, Florida lawmakers gutted the assignment of benefits for residential claims because the mechanism that was supposed to help homeowners get paid had become a machine for turning water damage into lawsuits. The payer pushed back so hard that the law itself changed. That's what this relationship does to the industry. It rewrites the rules. And any owner who doesn't understand that they're operating inside an insurance machine, not a drying business, is going to get flattened by it eventually. To see what that looks like when the machine really turns, look at what happened to our operator in February of 2021, when a winter storm rolled through Texas and froze the pipes across the state. Burst pipes everywhere, ceilings collapsing, water pouring through houses that had never seen a freeze like that in living memory. For the restoration companies already there, it should have been the year of their lives. The work was everywhere. The phones did not stop ringing for weeks. Our operator had been praying for a big event, and when it came, he did what the fantasy never warns you about. He took on debt to scale up. Extra truck, extra crew. He borrowed against the promise of a windfall. And then something happened that the fantasy never includes. The out-of-state companies showed up. Storm chasers, the industry calls them, rolling in from wherever the last disaster was, setting up in hotel rooms, running crews around the clock, and bidding on the same claims as the local shops. The homeowners, desperate and exhausted, signed with whoever was fastest. Some of those out-of-state crews did fine work, some did not, and some wrote scopes that the local adjusters had never seen before, pushing the estimates up and up. Within months, the complaints started. Homeowners who signed away their claims and never got the work finished. Insurance companies disputing invoices that had ballooned. Regulators fielding complaints about the disaster response. And the local companies, the ones who had been there for years, who had built their reputations one neighborhood at a time, found themselves fighting a wave of suspicion created by people they had never met. Our operator's carrier program paused. The adjusters he'd spent years earning the trust of started reviewing every invoice like it was a stranger's. His receivables stretched past 90 days. His crew had to be paid. The truck payment had to be met. And the storm of his dreams, the year of his life, turned into the year that broke him. He sold the extra truck. Then he sold the first one. Then he sold the equipment, at a loss, to a company that had come into town for the disaster and stayed. By the time the dust settled, the operator, who had won every race, who had dried every house, who had done everything the brochure told him to do, had a phone that stopped ringing and a stack of invoices he'd never collect. Keep this in mind if you ever think a storm year is a gift. The biggest years are the ones that attract the most competition, the most scrutiny, and the most legal trouble. The disaster that fills your schedule is the same disaster that fills your inbox with disputes. And here's the strange part. By every measure the fantasy cares about, our operator was good at this. His crews were fast, his drying was solid, homeowners loved him, the work was real, and the work was done well. So why did he lose everything while the company that bought his equipment at a discount went on to thrive? It wasn't the water work, it wasn't the fans, it wasn't the hours. The difference between what our operator owned and what that company owns was never in the van. It was invisible. It was the part of the business he never learned. And it's the part that decides whether the money actually arrives. The physical work, the extraction, the equipment placement, the moisture readings. Any competent crew can learn that in a season. The skill that actually decides whether you get paid happens on paper. The thing you're really selling is not drying. It's not pumping. It's not the fans. The thing you're really selling is an estimate. A scope of work, written out line by line in software, priced at whatever the industry standard says a piece of this job is worth, submitted to the adjuster, and approved or cut down line by line. That software is called Xactimate, and it is the closest thing the whole business has to a shared language. The adjuster speaks it. The contractor speaks it. When you write a scope, you are not describing what happened. You are building a document that converts a disaster into a number. How many days of drying do you claim? The machines run until the moisture readings come down, and every extra day is extra money. How many air movers do you list? The adjuster will count them. How many technicians? How many hours? How many trips? Each one is a line item. Each line item is a negotiation. Our operator had been writing scopes the way he'd been taught, then watching adjusters cut them. It took him a year to learn that a scope is not a bill, it's an argument. and the argument has to be won on paper before the work even means anything. He learned it in the middle of a storm, when the adjusters he'd spent years earning the trust of started treating his invoices like a stranger's. He didn't lose the storm because the drying was bad. He lost the storm because the paper was bad. And in this business, you don't always get a second chance to prove it. Which brings us to the structural truth underneath this whole industry, and it's the reason his phone stopped ringing instead of slowly fading. A restoration company's work comes from a surprisingly small number of places. Insurance carriers, who route claims to contractors they trust. Third-party administrators and independent adjusting networks, which act as middlemen, collecting vendor lists of vetted companies and feeding them work. A few big relationships can be most of the revenue: one carrier program, one network slot, one set of adjusters who like your work and trust your scopes, and that concentration is the silent dependency running through this entire business. From the outside, a busy restoration company looks diversified. Dozens of jobs, dozens of customers. From the inside, it's often one valve. One relationship that opened the pipeline, and one relationship that can close it. Our operator didn't lose dozens of customers on the same day. He lost one carrier program, one valve, and that was all it took. When a carrier decides a contractor's invoices are too aggressive, or a callback turns into a complaint, or an adjuster simply stops being impressed, the jobs can stop coming almost overnight, not because the company did anything wrong, because the payer's trust is the asset, and the payer is a stranger who was never hired by you. That's also where the quality pressure lives, and it's the part of the machine that grinds quietly. Restoration crews work physical, wet, dirty hours, a big chunk of it between midnight and 6 in the morning, because that's when the pipes burst. The crews are on call, which means the company pays for the right to be woken up, not just for the hours worked. Turnover in this kind of field work runs 30 to 40% a year. You train a tech, certify them, trust them with a truck and a customer's flooded living room, and then they leave. Sometimes for $2 more an hour down the street, sometimes because the 3 a.m. calls burned them out. And then there's the callback, the quiet killer that never shows up on the balance sheet until it's too late. You dry a house, get the readings down, close the job, move on. 3 months later the homeowner calls. There's a smell in the wall, mold where the water had been. Whether the drying failed or something else failed, the homeowner is furious and the insurance company is taking notes. One failed dry doesn't just cost you the rework. It costs you the adjuster's trust, it costs you the carrier relationship, it costs you the referrals. In this business, quality isn't just a professional value. It's the thing the payer uses to decide whether you keep getting paid at all. Our operator's work was never the problem, that's the cruel part. He did the hard part right, and it still wasn't enough. Which brings us to the question that hangs over every one of these companies, and the one most owners don't want to answer honestly. If the margins are real and the demand is real, why are so many of these businesses nearly worthless? Why can a busy, profitable-looking restoration company be almost impossible to sell? Our operator answered that question himself on the day he sold his equipment at a loss. The buyer didn't want his name. He didn't want his phone number. He wanted the fans. The buyer knew the same thing our operator never learned. The business is the owner. The owner is the salesperson who wins the calls. The owner is the estimator who writes the scopes that survive the adjuster. The owner is the relationship with the carriers, the networks, the adjusters who feed the pipeline, and none of that can be handed to a buyer with the keys to the van. When the owner walks out the door, the relationships walk with them. What's left is a stack of equipment anyone can buy and a phone number that stops ringing. A one-man shop, or even a 10-man shop where all the relationships live in one head, is not really a company, it's a job with a fleet. And a job with a fleet doesn't sell for what a company sells for. So does owning a water damage restoration company actually work as a business? The honest answer is yes. And the honest answer is yes. And the honest answer is that it depends on conditions that have almost nothing to do with the fantasy you started with. In the good case, you own a shop with a real cash buffer, scopes that survive the adjuster, a pipeline spread across more than one carrier and more than one network, and a system that runs when you're not in the room. That shop can be genuinely profitable, genuinely valuable, and genuinely durable. In the bad case, you own a shop where the whiteboard is full, the bank account is empty, one relationship feeds most of the work, and everything stops when you stop. That shop can be busy and impressive and worth almost nothing all at the same time. Both of these shops do the exact same work. Both wear the same uniform. The difference is not hard work. Everyone in this industry works hard. The difference is understanding what the business actually is. And here's the final thing to hold on to. The vans, the fans, the dehumidifiers, the certifications on the wall, Those are the cheapest and most replaceable parts of this business. What you're really buying, what you're really running, what you're really risking, is a flow of claims you can capture, and the trust of the people who approve and pay them. Trust that doesn't fit in a truck. Trust that walks out the door with you. The homeowner standing in the flooded basement at 2 in the morning isn't hiring a drying company. They're hiring the person who's going to walk them through a disaster and hand them a check at the end of it. The check comes from somewhere else. The approval comes from someone they'll never meet. And the business, the real business, lives entirely in the space in between. The company you think you're buying isn't the water business. It never was. It's the claim business. Our operator is out of it now. The company that bought his fans is still running. That's the whole difference.